This computer. Okay, good morning once again. And just before starting, I just would like to give you quick reminder about the next week's quiz day that we're gonna have it on Friday. Yes, Friday. No, Thursday, yeah? Yeah, it's Thursday, 5th of June. It's gonna be Thursday, it's a quiz. So the chapters that you need to study, you already know. And today we're gonna start a new chapter, and then we'll cover one more chapter before the midterm too. And then we'll kind of finalize these things, the midterm too. So this chapter is all about the interest rate. In this chapter, we'll discuss how the financial institution, they quote the interest rate and compute the effective annual rate on a loan on the investment. So we'll apply the time value of the money equations by accounting for compounding periods per year, and we'll set up like monthly amortization table for consumer loans. And of course, we're going to illustrate them, how they change as the compounding and annuity period changes. And we'll explain the real interest rates and the impact of the inflation on the nominal rates, how these interest rates are calculated, and how they're kind of quoted by the banks. And of course, we're going to summarize two major premiums that differentiate the interest rates. One is the default premium, the other one is the maturity premium. We'll discuss like what does each premium means and what the premium itself actually. And we're trying to understand the implication of the yield curves. And of course, at the end of the day, you will amaze your family and friends with your knowledge of the interest rate history that you're gonna get it. Okay. So most common rates that are quoted by the banks and the financial institutions are called APR, or annual percentage rate. So whenever you go and make an agreement with the banks, the bank will give you rate. Like go to any bank that we have it in Kazakhstan, Forte Bank, Halyk Bank. You see, they give you the rate, like this rate will be charged on the banking industry. And do you know what is the interest rate nowadays in Kazakhstan? Not the discount rate, but this. No, you're talking about the discount rate. I don't know any bank that charges 15%. Like 20 and above, like 22% and above. Like Kaspi, if I'm not mistaken, they charge 36%. The interest rate, if you want to get the loan, you have to pay the 36% per year. It's something big enough. And of course, the reality of this, where they quote APR, they say this is the APR, but in real terms, you pay much more. In real terms, you pay the effective annual rate rather than an APR. APR is just a show off. They just show you that this is the rate that you're going to be charged for a loan. However, the real interest rate that you're going to be paying is effective annual interest rate, which is called effective annual. It's a true rate of return to a lender and the true cost for the borrowing. And the way it's calculated is here, like 1 plus APR over the number of periods raised to the number of the period minus 1. So let's get the example here. The First Common Bank has advertised one of its loan offerings, like we will lend you 100,000 for 3 years with an APR 8.5. Look, they quote here 8.5% rate. However, in reality, they're going to be paying much more. Interest compounded monthly. If you borrow 100,000 for 1 year, how much interest will you have paid, and what is the bank's annual percentage yields? Okay, so nominal annual rate is APR is 8.5. Frequency compounding is the 12 periods, and the periodic interest rate is it's 0.70% less than 1% per month, and effective annual rate or annual percentage yields is equal to 8.83%. So in reality, you pay 8.83%. So total interest paid after 1 year basically becomes this much. Okay, I would like to illustrate this example in Excel too.
So this is how much the person is overpaid?
Yeah. This is in real term how much it pays. The banks tell you you're gonna pay like 8.5%, but in true case you pay 8.83%. Okay, 8.83 and 9. But imagine the APR is higher, then the effective annual rate will be much, much higher. We'll illustrate now. Imagine we've got here, I think we've got effect. It's like effective annual rate we have. We put like 8.5% here. And we put the number of periods, which is 12, like monthly. Okay, that's what it gives us. So this is effective annual rate. So it's same that we calculate by formula, 1 plus APR over the number of period over the number of periods and so on. But imagine it's a case of Kazakhstan, like 24%. If it's 24%, APR like 26, even higher, even the higher, okay? If it's 30, 24, it's the lowest actually. Jusan Bank charges around like 28%, they said. 28. It's like 32% ineffective you pay an annual rate. What this means, okay? What does it mean? Imagine you borrow 30%, you borrow 30,000 tenge or 300,000 tenge, let's say from the Kaspi Bank, okay? You borrow 300,000 tenge for 5 years. How much you will be paying in total? So basically you're going to be calculating the future wallet fees. So rate is no, it's not. It is how much we use 28? 20. Yeah, with 28% here we used it. This is effective annual rate, like in here in terms like in true rate, how much you pay. But the future value when you use it, it's already converts into effective annual rate. Number of periods is 5, and present value is this. Imagine how much you overpay. You borrow 300,000. Your overpayment is basically 2,300,000. So 2,300,000, it's interest that you're going to be paying to the bank if you borrow this much. It's reality. You buy the car, you pay the much. But nowadays, for example, the new cars, I was having I'm frequently kind of investigating these things. There are some interest on the banks, the special interest they call it, they give like 4% per year, which is good. Like if you buy a certain car, they will finance through one bank, let's say Forte Bank, by 4% that interest rate. And if it's 4%, just calculate 4%. The overpayment for 7 years is not that much big as it should be. Okay. But wait a second. Yeah. Yeah. You borrow 300 and just overpayment 64,000. It's not that much. Even the inflation will be much, much higher. Okay. Jim needs to borrow 50,000 for a business expansion project. His bank agrees to lend him the money over the 5-year term of APR of 9%. Will accept either annual, quarterly, monthly payments with no change in the quoted APR. Calculate the periodic payments under each alternative. Compare the total amount paid under each option. Okay. So basically you're given APR 9%, 50,000 of the business loan, and you're asked to calculate the total payment. So here what you're going to be doing here, actually, the annual payments will be 12,000 and quarterly payment. Okay. About the periodic payments, okay, we have some different periods payments, which is not mentioned here. It's basically annual, which means once in a year. Semi-annual, it's twice in a year, okay, every 6 months. Quarterly, it's 4 times in a year. Monthly, 12 times. Weekly, 52 times in a year, and daily. Sorry? Bi-weekly? No, we don't go for it. And daily is 360 or 365, one of us. Okay. So these periods we're going to be using to convert the APR into. If the APR is given, let's say monthly, then you just divide it by 12. If the APR is given semi-annually, you're just dividing by 2, like converting to that month. Like imagine if the yearly rate is 12%, then monthly rate will be, let me put it in this way. Yeah. So annual, it's basically 12 divided by 1. Yeah. Semi-annual, 6%. Okay. Leave it around 60. I convert into percentages. Okay. So 12%, 6%, 1.5%, 0.12% monthly, less than 1%. No, it shouldn't be like this. It should be exactly 1%. Oh, I did not fix it, sorry. I should have fixed it this. Okay. 3% quarterly, 1% monthly, weekly 0.23%, and daily 0.03%. This is the way that we convert the percentages, okay? If the annual percentage rate is given and whatever you're asked to calculate, then you need to convert before putting everything into the formula. That's why we will calculate actually. So money over this 5-year term will accept either quarterly, monthly payments and with no change. And in here we are getting annual payments. Total payment is here. Quarterly payments, it's basically 5 years. But here, if this is the case, but let's use this example. I'm going to use the 9%, okay? And the number of periods we said is 5 years. If this is the case, so in terms of the periods, in 1 year, 5 years is 5 years, okay? 5 multiplied this. What about if it's semi-annual, if it's 5 years, how many periods we have? 10 periods, okay? If it's quarterly, we have 40 periods, yeah? If it's monthly, we have 480 periods. If it's weekly, we have, and so on. Basically, what you should understand in here, the interest rate is divided by the number of periods, and the years is multiplied by the frequency of the periods. Okay. So here we multiply, here we divide. Yes. Yeah, that's very good question. Again, we did not fix it. Perfect. Thank you so much. We should have fixed it. It moved down when I was just pulling down. Okay. Now it looks more correct, yeah? Perfect. So in here you can see that quarterly payments, we have number of periods 20, interest rate will be divided by 4, and so on. If this is so, we can calculate the total payment for each, okay? Let's do it, PMT, and see which one is like more advanced. So if it's yearly, you select this. Number of period is 5, we said. Present value, how much was it? 50,000? Yeah. And that's it. And we put a negative sign here. Okay. That's what we have it. Like yearly. Are we matching? Yeah, we are going good actually. Quarter, monthly, semi-annual, but what do? You just convert them into yearly basis. You just multiply each to compare, okay? Which one is giving you better option? Let's say not the better option, but in terms of if you borrow this much, which option would you go if you borrow this money? Either you're going to be paying quarter, because for example, when I used to work in Cyprus in construction company, we used to finance our projects and we were offering the clients, would you like to pay the quarterly, semi-annually, monthly, or once in a year? So we were giving this option to these customers, and the customers were deciding. Imagine the same thing you are given. Not only the banks, they finance the projects. Even sometimes the big construction companies, they do financing their project themselves, like providing financing. So they might offer. So if you are given this type of alternatives, you might be feeling, well, let me pay once in a year, or let me pay 4 times in a year, or let me pay monthly. Which one would be better? So to do that, you need to compare. So we multiply by the number of periods, and we'll see which one is higher. So the more frequently you pay, the less interest you will be paying. That's the idea. So those clients who accepts and says that I'm gonna be paying once in a year, then he's gonna be definitely ending up with paying more interest. So that's the point, okay? As you can see here too, daily has got the least interest rate, but in here it's opposite. So you would definitely prefer, but in here, in our case, we were given monthly, quarterly, and annually, 3 alternatives, like annually, quarterly, and monthly. If you compare all of them, you would have definitely suggested to go with monthly. Any questions? Okay, comparing the annual and the monthly deposits, who is currently 25 years old and wants to invest in money into the retirement account, so to have $2 million saved up when he retires at age 65. So he's 25 years now, and when he retires and gets 65, if he can earn 12% per year in an equity fund, calculate the amount of the money that he would have to invest in equal annual amounts, alternatively in equal monthly amounts, starting at the end of the current year or month respectively. So basically, one is like annual deposits, the other one is with monthly deposits. So we can see in annual deposits, you're going to be paying 2,600 something, and monthly you're going to be paying 169. But still, you have to, if you multiply by 12. So before even the calculation, you have to, you know what to tell, like, you know what to advise. Because we said, the more frequently you pay, the more frequently the interest is charged, the less amount you're going to be ending up with. So we can do this and repeat an example. So the question in here, in equal monthly amounts, if he can earn 12% per year in equity fund, calculate the amount of the money he would have to invest in equal annual amounts, alternatively in equal monthly amounts, starting. Okay. So you should compare which one gives you the better alternative. 2 million, and in terms of the number of the years, we have 40 years and 12%. Now, we have 40 years, 12%, and 2 million. Okay. One is annually, the other one is monthly, okay? Now, if you calculate, so 40 multiplied by 1, 40 multiplied by 12. 12% divided by 1, and 12% divided by 12. And we can calculate the PMT. So rate is this. Number of period is this. And present value is this. No, we don't have, isn't the future value?
Okay.
Yes, perfect. Perfect. This is, we want to save up, like it's not the present value even. It's a future value payment. Because we're calculating for the retirement. Okay, that's what you get it, but I'm gonna fix this number. Oops. And that's what I have it. So if I multiply this by 12, so I can see that annual investment is more preferable. Like gives you by 600 more, 550, 555. Okay. So you would have definitely invest annually. Yes. Yeah. It's PMT. It's a PMT. Okay. Let me ask you in this way. If you want to save up 2 million, if you want to get in your retirement $2 million, okay? How much money you should deposit today? Either it's annually or monthly, and which one would you prefer to do it? Monthly, because you will be investing less. Okay, another question. Let's say that you have decided to go monthly, and this time passed, you got your $2 million. For the remaining 20 years, let's say that for the next 20 years, starting from your retirement age, how much money you will be receiving monthly from this 2 million? Assuming that there is a still investment, you put this money into investment account that offers you something that, because you cannot withdraw, but still it will be worth like 6%. So you have to calculate PMT of what? Future value or present value? Present value for that, okay? Interest charged only on the outstanding balance of the typical consumer loan. Increase the frequency size of the payment results in reduced interest charges. So the quicker the payoff, the due to the more money being applied to loan balance each month. So amortization schedule help in planning and analyzing the consumer loans. So let's imagine that the K just taken out the loan of 200,000 for 30 years and 5% mortgage. And she has heard from friends that if she increased the size of her monthly payment by 1/12 of the monthly payment, she will be able to pay off the loan much earlier and save bundle all interest costs. However, she is not convinced yet. So use some necessary calculation to help convince her. So that is in fact true. So tell me, what is her monthly payment now if she borrows $200,000 with a 30-year and 5% mortgage? So we need to calculate the PMT, yeah? PMT rate is 5% divided by 12, yeah? Number of periods, 30 years. Present value, or we don't have present value. 200,000 divided, multiplied. We don't need to do anything here, huh? Okay, that's her monthly payment if she borrows the loan. But the question in here, it says, if she increases the size of her monthly payment by 1/12 of the monthly payment. So if this will increase by 1/12, by this amount. By $89. So plus 89. Okay. By this much in total. If she will be paying this much, will she be paying less in terms of number of period or more? We have to calculate. So you need to calculate what? No, PMT we did it. NPR, yeah, number of period. We need to calculate how much time she will need when she pays this much money to cover her debt. So NPR, number of period, rate is 5% divided by 12. PMT is this, and present value is 200,000. Okay. 303. And we divided by 12, yeah? So in total, she will be paying her debt in 25 years. So if she increases by 1/12 her monthly payment, her number of periods will be reduced from 30 years to 25 years. So increasing the size of the payments is good. So you can show this calculation to her and she will be kind of convinced. Okay. Any questions? Okay. With a minimum monthly payments. Okay, what is this? With a higher monthly payments. Okay, how much you will be paid? That shows that if you will be paying like $1,073, this much interest paid you'll be ended up with. But if you pay earlier, this much you will have it. Okay, nominal risk-free rate is the rate of return interest earned on the risk-free investment, such as bank CDs or treasury security. Basically, nominal interest rate is the rate that the bank charges because it includes real interest rate plus inflation plus some premium. Because the banks, when they lend you the money, they lend you with the hope that they control the inflation. Because inflation is very critical and very crucial for the bankers, and they do pay attention a lot on that. So whenever they give you with considering the inflation. So the Fisher effect shows below the equation the relationship between the real interest rate, R with star, and the inflation rate, and the nominal interest rate, just R. H is the inflation rate, and this is the real interest rate. So whenever they will charge you the rate, they will charge you this rate, okay? Which will include the real interest rate plus inflation plus some other premiums, okay? Like default premium, risk premium, maturity premium, which we will discuss later on. So Jew has $100 tempted to buy 10 t-shirts, with each one costing $10. However, she realized that if she saves the money in a bank account, she should be able to buy 11 t-shirts. If the cost of the t-shirt increases by the rate of inflation, 4%, how much would her nominal interest rate of return have to be? Look, to calculate the nominal interest rate and the real interest rate here, first of all, we need to understand the price of the t-shirt was $10, means that $100 she spent to buy the 10 t-shirt, where each t-shirt costed just $10. But now she realized that if she saves the money in the bank account, she should be able to buy 11 t-shirts. What should be then the bank deposit rate or the rate of return on that case? How can you calculate? Like how much money she will make it if she put this $100 and later she can buy 11 t-shirts. How much money she can make it? How much money she will have at the end of the day? 110, yeah? 110. And the percentage the bank will charge as interest is 10%, yeah? How can you calculate? Basically using the formula or the logic that you use, like 11 t-shirt, 10 t-shirts, raised to the 1/1 and -1, which is 10 t-shirts. So price of t-shirt the next year will be 10.40. And total cost of the t-shirts will be, why 10.40? Because it's inflation. It's inflation we have it. And total cost of t-shirt in total, because you're going to be purchasing 11 t-shirts, and you will be ending up with paying $114. And if you want to calculate rates of using the total t-shirts, then you will be able to do that in the following way. So we have two alternatives to calculate. One using the Fisher effect, the other one using the formulas, okay? That is given here. Like price of t-shirt here. Now she has $100 and she can buy 10 t-shirts, yeah? But we want to buy 11 t-shirts. Easily we can calculate the rates that it increases, the banking rate, which is 10%. We can just put rate, number of period we said is 1 here. PMT, we don't have it, but we have the present value, which is 10, and future value is this. That's 10%, we get it, okay? And we're using the Fisher formula where it says here, 10 inflation rate, real rate of return that you calculated, real interest rate, plus inflation, and real rate multiplied inflation rate. So 10% plus inflation, which is 4%, plus 4% multiplied 10%. So that will give you the nominal return. On the other side, if you want to calculate nominal return, you can use this way of the calculation, calculating the total t-shirts and then calculating the value. So you can buy 11 t-shirts, yeah? With the inflation rate, $10 for one t-shirt is basically multiplied by 1 plus 4%. That will give you the price of the t-shirt next year. And you want to buy 11 t-shirts next year, which in total you have to pay this much, 140. Okay? And you have 100 on them. Then what should be the nominal interest rate in the bank for you to do that, to buy that t-shirts? So basically 14.4%, you can just divide this by this, or you can just use the formula, rate, number of period 1, present value is 100, and this is the future value. Okay, that's what you get it. Or you can just calculate in the different way. This one minus 100 divided by 100. Like this. And divided by 100. Still we're gonna get the same answer. Okay. So the logic is to calculate the nominal interest rate using the Fisher effect and using the economical way of the calculation, where you will just consider both inflation and the real interest rate. Okay. Any questions? Okay. The nominal risk-free rates of interest, such as rate of return on treasury bill, includes the real rate of interest rate and the inflation premium. So rate of return on all of the other riskier investments we have to include default risk premium and the maturity risk premium. Example with the 30-year corporate bonds and the 30-year T-bond yield. So due to the increased length of the time and the higher default risk on a corporate bond investment, the return on the corporate bond will be higher because you take more risk, you have to be compensated for that. Higher risk, higher return. So the longer the time period, if you compare with the less time period, you'll get more return in the longer period of time. Because in the longer period of time, the probability that something will happen unexpectedly, some unexpected circumstances will arise is high. So that's why you have to be compensated for it. And there are some securities like default, like we have some companies that are known, that we have some companies that are belonging to government, okay? And if you compare the governmental securities and like private securities, governmental securities are more stable and less risky, which means that they will pay less return to you if you compare to private companies, like treasury bills and the corporate bonds, or treasury bonds, like it's a governmental bonds. The government is more secured, government is more stable. On the other side, when you say the government is more stable, it doesn't mean that the government has free risk. No, the government still there is a risk. Like take the example of Greece in 2011, 2012. What happened? They defaulted. The government borrowed money by issuing the bonds and they defaulted. They could not pay the money back. The Greece bank defaulted itself. And they forced the Cypriot banks to pay their debt. Still, it wasn't enough. And they bankrupted the banks in Cyprus too. So when we say that it's more stable, it does not necessarily mean zero risk. No, it's not a zero risk. There is a risk, but it's less risk than if you compare to the private companies. Like, can you tell me if you compare the return, let's say, of two banks, one we have, let's say, which bank would you say has got higher return? Halyk or Jusan Bank? Who has more return? Who might have more return? Okay, let me go. Who is more risky, Jusan or Halyk? Who has got more probability of riskless? Jusan, because Jusan it's a private company, it's a foreign, yeah. And Halyk is like government-supported banks. Yeah, it's more like national bank related. So, and the return on Halyk Bank, yes, there's a hand want to ask something. Okay, it's just stretching. I guess I thought it's raising the hands. Now, the Halyk Bank is less risky, and of course, it will pay less return if you compare to Jusan Bank. But it depends on the investor type, like if it's risk averse or risk lover, depending on that type of investment, he will decide what investment, what bank she should invest or not. Any questions? Okay. Yield curves, it's a graphical depiction of the relationship between the interest rate and the maturity date of the financial instrument, where the most of the curves are upward sloping, and sometimes it can take the opposite, like called an invert sloping in here. It's like upward sloping. As interest rate increases, the time to maturity will increase too. And the more rewards will be required, you'll be getting for it. Like interest rates, it's a banks when they give a loan, and as the maturity increases, they give more. They ask more interest on that, okay? They charge more interest. If you compare the loans like which are 7 years and the loans which is 1 year, 7-year loans has got higher interest than the 1-year loan. That's called the upward sloping yield curve. And sometimes when there's a crisis, it's downward sloping. The banks are willing to less pay the amount of the money or charge less, and they're willing to less lend the money to the individual and the corporates. Okay. Just skip this. So 50-year analysis of his, I'll skip the history, okay? I'm not gonna talk about it. Now, let's calculate annual percentage yield or effective annual rate. The First Federal Bank has advertised one of loan offering as follows. We will lend you $100,000 for 5 years at an APR, which is 9.5%, but compounded monthly. If you borrow 100,000 for 1 year and pay it off in lump sum amount at the end of the year, how much interest will you have paid? And what is the bank's effective annual rate? So frequency compounding is the 12 months, and if you calculate the effective annual rate, it's gonna be not 9%, it's 9.5%, it's gonna be 9.92%. So the total interest that you're gonna be ending up paying is here, like in 9,924. That will be your total interest, amount of the interest paid with the effective annual rate in concluding. Again, if you just use it in Excel, I put like effects, nominal interest rate 9.5%, and it's monthly. So that's what you have it. Okay. The First Federal offers you structure of 9.5%, 100,000, 1 year loan on a monthly payment basis. So calculate your monthly payment, amount of the interest paid at the end of the year, and what is your effective annual rate. So you need to calculate PMT, and total interest paid is basically here. What do you have it? So you borrow 100,000, your PMT is 8,768, and it's 12 periods. Like monthly, you're gonna be paying 8,768. However, if it's 12 months, so in total you have. So let me do it here. PMT rate is 9.5%. Number of periods is 12. Present value is 100,000. That should be divided by 12. Okay, 8,767 or 68.35. But this multiplied by 12. So in 1 year, I will get this one, and minus 100,000 will give you the total interest paid. Yeah, it's PMT.
Explain the logic behind this effective interest rate and the annual interest rate, why the actual interest rate is higher by 9.9.
Yeah. Actually, APR, it's 9.5%. Yeah, it's like, which is quoted rate, annual percentage rate. And we have effective annual rate, which is, yeah. What is the difference between this and this? The difference is that in the first one, it's just a rate that shows like, this is the quoted rate. Rate is yearly rate, and you're not going to be paying interest on the interest. But in reality, when you borrow the money or when you deposit the money into the bank account, you pay interest on interest, because the interest you generate in that month, you will reinvest and you earn more interest on that too.
It's like if we had 100 tenge in our deposit account for 1 month, then we're 10%.
Yeah.
It will be 110.
Yeah.
So
Then you
will
100,
be multiplied
110. That's very true. That's the main logic.
logic.
Yeah, but the banks, when you go to the banks, they show you this APR. They don't show you the effective annual rate. Effective annual rate, basically, it's mentioned. It is mentioned in the contract, but very deep somewhere hidden. and you wouldn't be able to find it. And with a small letter, they never show that this effective annual rate is this much. Yeah.
Normally, they're using future value, present value.
It calculates. It already calculates. It's called compounding. If it's a present value issue, we call it discounting. If it's future value, we call it compounding. Okay. The Patrick needs to borrow 70,000 to start the business expansion project. His bank agrees to lend him the money over 5-year term at an APR of 9.25% and will accept either monthly or quarterly payment with no change in quoted APR. By the way, in the question, if you see the word APR, that's the mistakes I have from the previous semesters from my students. They see the APR and they rush to calculate effective annual rate. No, don't do that. Like before, read the question completely, what the question asks you to do that. So APR is just annual percentage rate. It's just a discount rate, yearly discount rate. It does not necessarily mean that you should go and calculate effective annual rate. It just gives you this is the annual rate. Calculate the present value, calculate the future value. Because I found the students, I gave the question, they didn't even read the question all, they rushed to calculate the effective annual rate. So it means whatever they did it wasn't correct. Because if the question was asked to calculate the future value, right, you are given the APR. So read the questions till the end, then you decide. So calculate the periodic payment under each alternative and compare the amount paid each year. In here, you see, it doesn't ask you to calculate the effective annual rate. It tells you to calculate payments and compare them. So you have two payments, like monthly payments and quarterly. Monthly, you're gonna come up with this, and quarterly, you're gonna be coming up with this. The total amount paid per year under each payment type is here. So you make your decision, which you might go with. So if she borrows, she will borrow definitely with the one that she pays. No. Yeah, that's true. Monthly, because the monthly pays less interest. More frequency, less interest will be paid. Okay. Since less interest is paid over the 5 years with the monthly payment terms, the Patrick should accept the monthly rather than the quarterly payment terms. Computing the payments for early payoff. You have just taken 30 years. Okay, you do it. We did it the same example. You try to solve it. So you have to calculate first payment, and then you have to calculate the number of periods. No, it's here. The number of periods is given to you, 15 years. You have just taken 30-year loan, fixed mortgage, and would like to pay off in 15 years. Very good question. By how much will your monthly payment have to change to accomplish these objectives? First, you calculate your total payments with the given conditions, and then what will happen with another given condition. So you basically need to calculate two different total payments.
Should be multiplied by 9.
Did you get it? 30-year, 6%. And you're gonna be calculating the PMT first. Rate is 6% divided by 12, yeah? 30 multiplied by 12 and 300,000. That's your first total payment. But what if, how much it should be? How much it should be when it's 15 years? Make this one 15 and get the difference. This minus this. 732. Did you get all the same? Okay. So for her to accomplish this objective, her monthly payment should change from 1,798 to 2,500. Any question?
Can you see the answer?
Yeah, sure.
No, like,
On the slides. Yeah, it's the same. So you just turned 30 and you decided that you would like to save up enough money so that you will be able to withdraw 75,000 per year for 20 years after you retire 65, age 65. So with the first withdrawal, starting on your 66th birthday, how much money will you have to deposit each month into account earning 8% per year? Interest compounded monthly, starting 1 month from today to accomplish this goal. So try to do it. Yeah, sure, of course.
Mortgage, it's like the loan that we take from bank,
Yeah,
the 300,000 is like a future amount.
no, we get it now. Look, all the loans, we get it now. Whatever the loans you get it's yours now. You got it now, the mortgage loan. You remember I told you from the beginning, like, if it's a loan, it's definitely present value because that money you get it now, not in the future. Okay. It could be car loan, it could be mortgage loan, it could be just any project finance loan. But all of them are present value. So go with this question. So you just turned 30, okay? You're 30. Let me help you with this question. You're 30 now. And you decide you would like to save up enough money so that able to withdraw 75 for a year when after your age. So when you're 65, you will be retired, and next 20 years, okay? Next 20 years, okay? You want to receive 75,000 every year. Like it's a pension, okay? Like you are here. And when you're 65, so how much you should save up here so that you will be receiving $75,000 every year. And interest rate is 8% per year, compounded monthly. But how much you should have it here? Another question, how much money you have to deposit each month into account earning 8% starting 1 month from today to accomplish this goal. So you want to receive $75,000 when you're 66, first payment, but you don't know what is the amount should be here in order to receive it. But to do that, you need to know how much money you should deposit today every month so that you come to reach this amount. Did you get the question? First of all, you should find what is the 65th amount here. So that
So,
it's a yearly, guys, but the interest compounded monthly. So in here, this interest rate should be converted to effective annual rate directly, but it should be yearly. So you want to receive your pension every year, but interest rate is compounded monthly. So you have to calculate what here? Present value, annuity, yeah? So present value, annuity. So rate is what? 8%. Yeah. Number of periods? 20. And payment? 75,000. So total amount you should have here, 720,000. Did you have it all? So basically this part is what? Effective annual rate, yeah? It's a monthly compounded, we said. But on a yearly basis. This is like specific question, guys, where you convert halfly. Number of periods, you don't convert it, but you convert only the interest rate. Or I can do it in this way. I'll just cut it and paste it here. Oops. Okay. I'll just use this. When we use interest rate monthly and periods yearly, then we have to use effective annual rate greater than APR. Is that clear? Look, in here, we are not asked to calculate monthly payments. You are given the yearly payments, but with the interest rate compounded monthly. So you need to convert that one into monthly payments. But let me see whether it's gonna work like this. 8 divided by 12. No, my bad.
you spend divided by 12, 20 by 12, and 75,000 by 12.
75,000 by 12? Yeah, to make it monthly? No, it's not gonna work like this.
But 7,000.
It's not gonna, because we are asked to calculate actually yearly. We want to receive the pensions yearly. This one by 12, you mean like this?
No, multi. Okay. Yeah, 12 by 20.
Oh, sorry, my bad.
Yeah,
No.
that's the same range.
No, why should you do that? Why you're doing it? Because the question is asked that the guy wants to receive yearly. He doesn't want to receive monthly. He wants to receive this $75,000 yearly. He doesn't want like monthly. Okay, that's why we partly convert, we partly don't convert it. Okay, it's not that. The question in here, what amount you should deposit every month so that you will reach this 720,000 from 30 to 65. You need to calculate PMT. PMT of what? Future value or present value?
Future value.
PMT of future value. PMT of rate in here we use 8% divided by 12. We don't use effective annual rate because now we convert both periods and interest rate. And number of periods?
530.5 multiplied by 12, but we have to subtract the 1 month because in the, it was says 1 month.
Later, yes, because it is ordinary annuity, yes?
Yeah.
If it was, yeah, we should not subtract anything. If it was beginning, we should have treated as due, but it's 1 month from now means ordinary annuity. We just multiply by 12 and future value, we have it as this much. Yeah. So every month we should deposit $313,000 so that we reach $720,000 when we are 65. And at the end of the day, we will be able to receive every year for 20 years, $75,000. That's the goal. This fine?
Yeah.
Why?
That's
Okay, let's clarify it. It's very important. Even if you're alone, we can do it all together. Again. So where's the point that you missed?
getting some.
Okay. Now, did you understand why did we use here effective annual rate, not the APR? Why? Look, when we calculate something, we use two factors. The first is the interest, the other one is number of period. If you convert both, then we use the APR. But if you convert only one of them and you don't convert the number of the period, then use the effective annual rate interest instead of the APR. So in here, the guy said, look, I don't want to receive my pension monthly. I want to receive my pension yearly. However, the interest rate is compounded monthly. So interest rate should be used as effective annual rate. So we use the effective annual rate instead of the APR. Number of the period doesn't change because we would like to receive the 75,000 per year. That's it. The interest rate that you use here, we don't use the APR. Like APR, we don't use it. We use only the effective annual rate. Again, the reason is that we are partially converting the function because interest rate is only the one that converted, but the number of period is still remaining yearly basis. Is that clear? Sure. Are you with us, Angelina? Sure. Physically, you're here. Okay, perfect. And monthly, we can calculate the PMT. Okay. That is very, by the way, it was the exam question for the last semester that I had it. And many students did not pay attention to this question. And again, I'm going to ask the question from slides from the end of the chapter books. 40% of the question will come from the slides and the end of the chapter questions. Please solve them, read the book, and practice as much as you can. Okay, this is where we have it, yeah? And that's all for this chapter. We are done with the chapter 5. Tomorrow we're gonna practice this chapter more. And in that way, we will finalize this chapter. And the next week, we will start a new chapter, which is the bond valuation. Any questions? Anything you would like to ask? Okay, thank you so much. That's all for today. Everyone present today? Today?
Not today, just.